Do not let the weekend headlines fool you into thinking this is a temporary spike. Do not let the fear of open-air warfare in the Middle East push you into selling your position. I know what you saw when you woke up this Saturday, February 28, 2026. You saw explosions over Tehran. You saw gold punching through $5,300. You saw analysts tripping over each other, trying to explain what just happened. They want you to believe this is a panic trade. They want you to think it reverses the moment a ceasefire rumor surfaces. They are wrong. Because behind today's war premium sits a 15-month-long operation that has nothing to do with panic. It is called the People's Bank of China, and it has been buying gold without interruption since November 2024. Ladies and gentlemen, Vault Tracker here. It is Saturday, February 28, 2026. You need to understand what that means. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let us map the technical architecture that made February 28th possible. Because the price of gold did not leap through $5,300 because of a single day's events. The structure that carried it there was assembled over months of deliberate construction. Begin with the price journey. According to market data, gold entered 2026 in a position of technical dominance. The metal breached $4,500 per ounce in late 2025 and closed that calendar year with a gain of nearly 70%, the strongest annual performance since 1979. January 2026 then became the most aggressive single month in gold's recorded history. 11 all-time highs in a single month according to World Gold Council tracking. The LBMA gold price PM delivered a return of 14% in January alone, the strongest January performance since 1980. In renminbi terms on the Shanghai market, sources confirm the same month produced a 19% advance, the strongest January ever recorded in local currency pricing for Chinese investors. The January record-shattering advance peaked near $5,600 per ounce before pulling back sharply. That pullback, driven by the Kevin Warsh Federal Reserve nomination shock, carved the corrective low at $4,403.24 per ounce, as per exchange data. From that floor, the recovery architecture began. The metal found support exactly where it needed to, at the $5,000 level and at the 1,000 renminbi per gram threshold in Shanghai, building a higher-low pattern as fundamentals reasserted dominance over speculative noise. The inverse head and shoulders anatomy of this recovery is textbook. The left shoulder formed as gold rebounded from the early February corrective low near $4,400 and began stabilizing above $5,000. The head represented the brief dip testing that $5,000 support with conviction before buyers stepped in. The right shoulder constructed across the February 20th through February 27th consolidation range, where gold churned between approximately $5,100 and $5,200, compressing energy into the neckline zone of $5,200 to $5,250. Exchange data confirms gold trading at approximately $5,200 on February 27th. Then February 28th arrived, and the neckline was not nudged, it was detonated. According to confirmed market settlement data, COMEX gold futures closed at $5,279.60 on February 28, up 1.64%. Spot gold settled at $5,275.82, analysts note. The intraday high reached $5,299, a hair's breadth from the $5,300 psychological battlefield. The line in the sand at $5,300 is now within reach. Analysts note that if Monday's open holds above $5,250 and the military campaign extends beyond its initial weekend as Trump stated, the $5,300 threshold becomes the base case within the first week of March. The coiled spring energy compressed through 20 days of consolidation between $5,100 and $5,200 has been released. The question now is velocity and destination. Here is the mechanism that the headlines missed. Behind the geopolitical detonation of February 28th sits a structural buyer who does not care about Operation Epic Fury, ceasefire timelines, or COMEX settlement prices. That buyer has been operating in the shadows for 15 consecutive months. That buyer is the People's Bank of China. On February 7, 2026, the State Administration of Foreign Exchange released the January reserve data, as per official reports. The PBoC had added a further 1.2 tons to its official gold holdings in January, bringing the total to 308 tons, 9.6% of total foreign exchange reserves, the highest gold share of Chinese reserves in recorded modern history, according to World Gold Council data. The reserve value of those gold holdings climbed from $319.45 billion at the end of December 2025 to $369.582 billion by end of January 2026, a $50 billion single-month increase in the value of China's gold position, sources confirm. That 15-month streak, unbroken since November 2024, follows a prior 18-month streak that paused in May 2024. The PBoC has now been accumulating gold for 33 of the past 36 months, with only a 3-month pause. This is not tactical trading. This is not a hedge fund bet. This is a sovereign treasury reallocation program, operating on a decade-long strategic horizon. Now examine what that reallocation tells you about the hidden mechanism driving gold. The official figure of 2,308 tons represents 9.6% of China's total reserves. The global average allocation to gold among central banks stands at approximately 22%. Analysts note, China's official declaration remains less than half the global central bank average. That gap between 9.6% and 22% is not a coincidence. It is a roadmap. For China's allocation to reach the global average, the PBoC would need to roughly double its official holdings, adding another 2,300 tons or more at current reserve composition levels. At current accumulation rates, that represents years of continued buying ahead. But the official number itself may dramatically understate reality. According to analyst estimates reported by market intelligence sources, China's actual gold holdings are approximately double the official figure, around 5,500 tons. If that estimate is accurate, Beijing would rank second only to the United States with approximately 8,000 tons. The deliberate opacity of China's reporting is itself a strategic instrument. The PBoC does not want its accumulation activity to move the market against itself while still acquiring. Simultaneously, China has been executing the other side of the trade. According to Treasury market data, China's U.S. Treasury holdings had fallen to approximately $682.6 billion by late 2025, the lowest level since 2008, down from $760.8 billion, when Trump returned to office in January 2025. The swap from treasuries to gold is not hypothetical. It is documented, it is confirmed, it is ongoing. The structural significance of this rotation extends beyond Beijing's own balance sheet. For the first time since 1996, gold has overtaken U.S. Treasuries as the world's largest foreign reserve asset by value. Total central bank gold holdings now approach $4 trillion versus approximately $3.9 trillion in U.S. Treasury holdings, as per World Gold Council data analysis. This is not a footnote. This is a turning point in the international monetary architecture that has defined the post-Bretton Woods era. Two types of buyers are in the gold market on February 28, 2026. The panic buyers who entered today because missiles were flying, and the patient sovereign accumulators who have been building their position for 15 consecutive months without a single pause. The panic buyers are real. When two coordinated military operations launched in the early morning hours of February 28, striking Tehran, Isfahan, Qom, Karaj, and Kermanshah, simultaneously, targeting IRGC command facilities, missile production plants, naval assets, and leadership compounds. The immediate reaction was a flight to safety that any student of market history could have predicted. Safe haven flows are instinctual. The logic is simple. War creates uncertainty. Uncertainty creates demand for the asset, with no counterparty risk, no sovereign credit exposure, and no ability to be frozen by sanctions. That asset is gold. According to settlement data, gold responded with 1.75% in a single weekend session. But now separate the panic buyer from the strategic accumulator. The panic buyer will sell when a ceasefire rumor surfaces. The panic buyer will exit when diplomatic language softens. The panic buyer has a 3-day time horizon. The PBoC has a 30-year time horizon. Examine what was happening inside China's gold ecosystem in January, before any war premium existed. According to World Gold Council tracking data, Chinese gold ETFs absorbed $6.2 billion, 38 tons in January alone, the second strongest month in history. Chinese gold ETF total assets under management reached 333 billion renminbi, $36 billion, an all-time high. Holdings jumped to 286 tons, another record. The Shanghai Futures Exchange gold futures daily average volume reached 456 tons per day in January, 17% above the prior month, and a staggering 72% above the 5-year average. Analysts note, these are not fear-driven spikes from one bad weekend. These are structural demand signals from the world's largest gold consumer nation operating at full capacity before a single bomb fell. On the wholesale physical side, sources confirm Shanghai Gold Exchange withdrawals reached 126 tons in January, 11 tons above the prior month, with bullion dealers, jewelers, and manufacturers collectively pulling physical gold from the exchange at peak levels. Meanwhile, according to market intelligence, Chinese consumers across economic strata, from factory floor workers buying gold-coated jewelry as savings instruments to white-collar investors pouring monthly savings into gold accumulation plans, We're treating the metal not as a speculative asset, but as a primary financial safety net in a world perceived as increasingly dangerous. The weak hands in gold are the weekend warriors. The ones who bought the January spike to $5,600 and panicked when the Warsh nomination crashed the price. They are gone. What remains in the market on February 28th is a layered combination of long-horizon sovereign buyers, institutional ETF accumulators with record AUM positions, Chinese retail investors who have internalized gold as a savings mechanism, and now a fresh layer of geopolitical risk premium buyers who entered on February 28th's war news. All four categories are aligned in the same direction. None of them are selling into Monday's opening. Let us address the argument being made by the bearish camp. They say the $5,300 level is overbought. They say the war premium will evaporate. They say gold at these prices is pricing in a scenario that resolves diplomatically within weeks. Here is the contrarian case, and it is the one supported by everything Beijing has been doing for 15 straight months. China's U.S. Treasury holdings have declined from $760 billion to $682 billion in the 12 months ending late 2025, a reduction of approximately $78 billion, according to Treasury market data. Where did those dollars go? Not into European bonds offering negative real yields, not into yen-denominated instruments, into gold, into physical bullion that cannot be sanctioned, cannot be frozen, and cannot be devalued by a Federal Reserve balance sheet expansion. The swap is documented. The mechanism is clear. Now examine what happens to gold's price floor if that process continues or accelerates in response to February 28th. The military strikes and Iran's retaliatory attacks across U.S. bases in Bahrain, Qatar, Kuwait, Saudi Arabia, and the UAE represent the most significant escalation in U.S.-Iran relations in decades. Reports confirm. Every nation watching that escalation, every reserve manager in emerging market central banks across Southeast Asia, the Gulf, and South America is running the same calculation. If U.S. allies in the Gulf region can be struck by Iranian missiles, if the Strait of Hormuz becomes a potential disruption point, if the geopolitical architecture of the post-1945 era continues to fracture, then the case for holding dollar-denominated sovereign bonds as the primary reserve asset has weakened further, and the case for the asset with no counterparty risk has strengthened. Now compare gold's performance to the asset class most often presented as its modern competitor. Bitcoin advocates argue that crypto offers the same properties: scarcity, censorship resistance, no counterparty risk. And then a joint military operation launches against Iran. Nasdaq futures fall, equity markets bleed, and Bitcoin, correlated not to geopolitical safety but to risk appetite, comes under pressure alongside technology stocks. Gold advances 1.75% in a single session. The tortoise moves while the hare pauses for the weekend market close. The deeper contrarian insight is this: the global reserve managers who are selling treasuries and buying gold are not making a short-term trade on this week's headlines. They are making a statement about the next decade of monetary architecture. When the world's central banks collectively hold more gold than U.S. government bonds for the first time since 1996, when that crossing happens not through a single month's panic buying but through years of systematic accumulation, you are witnessing a structural repricing of what constitutes monetary safety. The tourist sees the war premium and worries about reversal. The diamond hand sees 15 months of PBoC accumulation and recognizes that the floor has been raised by sovereign hands that no ceasefire communique will lower. According to market intelligence, the gold-to-silver ratio compressed to approximately 56 to 57 to 1 on February 28 as silver's 7.67% single-session advance outperformed gold's 1.75% move. Historically, when the ratio compresses toward 50 to 1, it signals silver entering a leadership phase. But gold's advance at 1.75% on a day when the world's fourth-largest oil choke point came under existential threat demonstrates the metal's absolute resilience. The floor is rising. The question is not whether gold holds above $5,250. The question is when it closes above $5,300. 5 levels. 2 scenarios. 1 sovereign mandate. Level 1. The bedrock floor. $5,000 per ounce. This is the level where China's physical demand has demonstrated absorption capacity, where Chinese gold ETFs registered their second strongest month on record in January, and where analysts note consumers and investors actively bought on dips when prices fell toward this threshold. The $5,000 floor is reinforced by the PBoC's own strategic behavior. 15 months of purchases confirm that Beijing views $5,000 gold as accumulation territory, not exit territory. Level 2, the weekly support defense, $5,100 to $5,130. This range represents the consolidation zone gold inhabited during the February 20th through February 27th buildup. A sustained close below this zone would be the first sign that the war premium is fading faster than anticipated. Watch this level if a ceasefire announcement surfaces within the next 72 hours. Level 3. The current battleground, $5,250 to $5,279. The February 28 settlement zone. According to market data, COMEX gold futures closed at $5,279.60. Monday's gap-up open above this level confirms the institutional bid has not retreated over the weekend. A gap-up open is already anticipated by market analysts, sources confirm. Level 4, the psychological detonation, $5,300 per ounce. This is not just a round number. It is the level where gold last paused during its January advance. It is the level where analysts stated the COMEX gold rate was facing a hurdle, as per market reports. A confirmed close above $5,300 activates the institutional breakout thesis. The financial media cycle ignites. New sovereign buyers enter on confirmation. The self-fulfilling mechanics of a psychological breakout begin. Level 5, the measured move target, $5,400, the Goldman Sachs target, and beyond toward the JP Morgan $6,300 forecast, based on sustained central bank buying running at 585 tons per quarter, analysts note. Both targets were established before February 28's military escalation. The structural case is now stronger, not weaker. Scenario 1, sustained multi-day campaign. Reports confirm Operation Epic Fury is massive and ongoing, with stated objectives to destroy Iran's missile industry and annihilate its navy. If the campaign extends through the first week of March as anticipated, Monday's gap-up open pushes gold through $5,300 on its first attempt. Physical demand from Indian, Chinese, and Gulf sovereign buyers accelerates. The $5,300 level becomes the new floor, not the resistance. This is the base case. Scenario 2, rapid ceasefire negotiation. Oman or another mediator brokers emergency ceasefire within 72 hours. War premium compresses. Gold pulls back to $5,100 to $5,200. PBoC and Chinese ETF buyers immediately absorb. 15 consecutive months of sovereign accumulation do not pause because Oman held a phone call. The dip becomes the gift. Diamond hands add to position. Measured move toward 5,300 and beyond resumes from a fresh compression. Both roads lead to the same destination. The only variable is which road you take. The comment I need you to answer. Do you believe gold clears $5,300 before Friday, March 6th? Tell me below. This is Vault Tracker here. 15 months of silent sovereign accumulation. One Saturday morning detonation. The weak hands will panic at the news cycle. The strong hands already own their position. Stack now. Stay sharp. See you at the next level. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.